Well, first of all, it's really hard to determine a trend after one day of activity. As we saw, we had a couple of day correction in NASDAQ and then it came roaring back. And part of the correction was because of the Netflix earnings, not so much that they were disappointed, but they were more, in terms of the third quarter, not going to be as great as what they thought as far as the number of subscribers. So there's a kind of a bad news, good news thing with tech. So the good news is that tech is here to stay no matter what. The bad news is for tech is that if we start to get out of our stay-at-home environment and the talk of vaccine comes to fruition and businesses start opening more, not only worldwide, but even potentially in the United States, then some of the other sectors will start to do better, which could be more in the value line. I think the problem is trying to make a prediction right here. Every day is different and every headline that comes out does something to move the market, where there's been some small cap growth stocks that have had a good growth in terms of their balance sheets. But also today, for the first time in a long time, we actually bought a retail stock, which is Capri, CPRI. And what that is Michael Kors and Jimmy Choo's. And I think there's a couple of reasons why the retail space could actually be interesting. One is, as we know, last week we had a good consumer retail sale report. Two is that there's still more stimulus coming in. The European Union just announced about $1 trillion more of stimulus. We know that here in the United States, they're working on more of a package. And even though the unemployment numbers show that we could still see a rise in unemployment, the unemployment benefits most likely will continue. And people are people. They like to spend money. They don't like to save money necessarily. They don't like to pay their bills necessarily, but they do like to spend money. So we picked that retail stock because of where it was in terms of its risk. So I would say look at retail and maybe even financials. We've got through the big banks' earnings. We still have a bunch of banks to report. And if they don't disappoint that much, or if people are hopeful going forward, maybe we'll see some of that money roll out of tech and roll more into the financials and retail. That's going to be an interesting thing to see if it actually emerges as somewhat of a trend and not like what we saw before, a 1 or 2 day blip and then back to the doldrums. Because we're going into earnings, we had Netflix, that's out of the way, but we still have Amazon and Google and Facebook and Twitter, which actually reports, and Tesla, which I think everybody's anticipating. I would probably say that if they do have any kind of correction, just like what happened with Netflix, it went down to about 460 after hours, opened up the next day around 480, and now is trading back over 500. I would probably wait for the correction. But if it actually reports and comes in much higher, I would take that as an opportunity to take some profits and not necessarily chase the strength. Because, like you say, it could be a bubble, number one. And number two is we're in a situation where your risk would be very difficult to control. We've been talking about gold when it was trading down still at around 1600, and we said it was going to go to 1800. We got to 1800, and of course now we're getting another big move above that. So the target, is it 3,000? One thing I do know as a former commodities trader on the floor who specialized in gold and silver is that we used to have an expression, when your taxi driver tells you it's time to buy gold, probably the target. So I would take those analyst predictions with a grain of salt. With that said, what we have had is an interesting catch-up play in silver to gold over the last few days. That is potentially inflationary. And it would be no shock, especially to me, to find out that where we're really heading in the next quarter is more towards a stagflationary environment. And that, I think, is what gold is reflecting. Somewhat of the fear, but also the constant amount of money pouring in through stimulus has to at some point be inflationary. The dollar is going down. And there's one other interesting thing to keep note of, and that is the transportation sector, or the demand side, is starting to exceed a little bit to the supply side, particularly in manufacturing. So you add all of that up, money supply growth, a weakening dollar, gold rising, silver starting to outperform, and the possibility of more demand than supply, and that's really where we could see that gold go up to 3,000, and that's stagflation. So silver is an interesting metal. Back in the late 70s, early 80s, when gold was flying with inflation, so was silver, and it went up to about $40 an ounce and then came tumbling down, and has really basically, except for a few moves up and down, languished. Now, in the more recent times, and up until Tuesday, silver went up to $21 an ounce. That's the highest it's traded since 2016. And there's a couple of reasons why. Number one is because supply growth and everything we've just talked about actually is starting to sneak up a little bit in terms of possibility of an inflation type play. It's also an industrial metal, so if we're going to see any kind of improvement in the manufacturing sector, silver will benefit from that. But also, the most interesting thing about silver is its ratio to gold, which was sitting at a low in that gold outperformed silver for years, and now in the last couple of days particularly, and really since March, silver has started to play catch up. Silver is still a really good buy. It gapped up. At this point, the risk may be a little great, but any kind of consolidation I would be looking at as a potential to buy. $20 should be a support area. And of course, watch the silver relative to gold, because that will be your best clue that we're heading more towards an inflationary environment.